to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through the market noise. Today, we are tearing into Smithfield Foods. They just had a monster year, and all the headlines are screaming record profits. The company is painting a picture of an impenetrable fortress of growth.
Yeah, but let's be real here. Every CEO sounds like a genius in a bull market. Our job is to figure out if Smithfield is actually building a portfolio asset that can withstand a storm, or if this is just market hype built on a foundation of sand. So, let's get to it. Let's stress test this so-called fortress.
You really can't get a more confident statement from a CEO. I mean, listen to that. Shane Smith is basically taking a victory lap, telling the market, we didn't just get lucky, we engineered this. This is the new normal.
Right, engineered a shift. He's promising a foundation for multi-year growth. That's a huge claim. But words are cheap, talk is cheap. Before we even think about buying into that narrative, we need to see the raw numbers that are propping it all up. The bull case has to start there, and it has to be convincing.
And here it is, the number that's got everyone talking. $15.5 billion in net sales. We're not talking about some little growth stock here. This is a massive operation. That number represents 9.8% growth year over year. In this economy, pushing almost 10% top-line growth is some serious momentum.
Okay, I'll give them that. Nearly 10% growth on the top line is impressive. It shows demand is there. But we say it all the time here at Iron Financial, sales are vanity, profit is sanity. Anybody can grow sales by burning cash and slashing margins. So show me the real story. Show me the engine room.
And this is precisely where the bull case gets its legs. A 30.5% explosion in adjusted operating profit. They hit $1.336 billion. This isn't just about selling more hot dogs. This is about making radically more money on everything they sell. That is what operational leverage looks like.
Exactly. Think about that. They took that 9.8% sales growth and magnified it into a 30% boom in actual profit. This is what separates a well-oiled machine from a company that's just getting by. It proves they're controlling costs and managing their supply chain, not just riding a wave. And what does a confident management team do when they're flush with that kind of cash? They give it back to the owners.
You got it. Just look at this. They paid out $1 per share last year. Now they're telegraphing a move to $1.25 for the upcoming year. That's a massive 25% increase.
And that's not just a number on a slide. That is a powerful signal. Management is putting its money where its mouth is. They're telling shareholders, hey, those record profits you just saw, not a fluke. We believe the cash flow is real and sustainable enough to support a much higher payout. For any income-focused investor, that is a huge, flashing green light.
All right. So far, the fortress looks pretty solid. Big sales growth, even bigger profit growth, and they're handing cash back to shareholders. Okay, so we've established the headline numbers are huge. Record sales, exploding profits, a major dividend hike. From 30,000 feet, the structure looks incredibly strong. But a $1.3 billion profit doesn't just appear out of thin air. We need to pop the hood and deconstruct this machine.
That's right. We have to see which parts of the engine are doing the heavy lifting and which parts might be leaking oil. Because not all segments are created equal. And if you don't understand the core strength, you'll never understand the core risk. Let's get into it.
And this chart right here tells pretty much the whole story in a single snapshot. Just look at that first bar, packaged meats. We're talking over $1 billion in operating profit from one division alone. This is the financial bedrock of the entire company.
It's more than the bedrock. It's practically the whole skyscraper. I mean, fresh pork and hog production, yeah, they're making money, but they are completely dwarfed. Packaged meats is an absolute monster. Which is great, but it also begs the question, what happens if that one single engine ever starts to sputter? That is a lot of weight resting on one pillar.
And the thing is, this isn't some one-year wonder. This is the fourth consecutive year that the packaged meats division has cleared $1 billion in profit. This segment is battle-tested. I mean, think about the headwinds here. They stared down over $500 million in higher raw material costs. That kind of pressure would absolutely cripple a weaker company. They just absorbed it and still posted a rock-solid 12.5% margin.
No doubt it's a resilient division, it's the fortress. But you know what? That's not even the most dramatic part of the story this year. The real game changer, the thing that truly juiced the bottom line, came from what used to be their weakest, most volatile link.
Okay, now let's pivot. We have to talk about the part of the business that historically has just been a headache, a source of insane volatility and, frankly, a major drag on the stock's valuation: hog production. This segment is completely exposed to wild swings in commodity prices, and it has burned them and their shareholders badly in the past.
But this is where the story for 2025 gets really good. Management executed what I can only describe as a strategic masterpiece. They didn't just try to ride out the commodity cycle, they completely reformed the entire segment. They took a massive liability and literally turned it into a pillar of strength for the whole company.
This slide right here, this is the heart of the turnaround story. Just look at these numbers. It's almost hard to believe. In fiscal 24, the hog production segment lost $144 million.
It was a boat anchor, a massive anchor tied around the company's neck, dragging the whole thing down. It was a disaster that punished anyone who owned the stock.
Fast forward 1 year, it's now generating a profit of $176 million. That is a staggering $320 million positive swing on the bottom line in a single year. This was not an accident. This wasn't just luck with green prices. This was a deliberate, meticulously engineered plan. So the question is, how on earth did they pull this off? Here's the 3-step blueprint. First, right-sizing. They made the tough call to slash their internal hog production by millions of head. That immediately cut their exposure to volatile feed costs. Step 2, optimization. For the farms they decided to keep, they went in with a scalpel and relentlessly improved the cost structure and productivity. And third, strategic sales. They sold off excess inventories to partners, which not only streamlined their operation, but also brought in a cool $155 million in cash. This was nothing short of a masterclass in strategic execution. Whoa, hold on a minute. Let's just tap the brakes. Record profits, masterclass executions, strategic masterpieces. I mean, it all sounds a little too perfect, doesn't it? I'm sitting here listening to this incredible bull case, and the only question in my mind is this. Is any of this sustainable, or was it just a one-time financial engineering trick? A fortress always looks amazing from a distance. The real test is when you walk right up to the wall and you start looking for cracks in the foundation. Can they repeat these numbers? That's the only question that matters. Exactly. You never take the architect's word that the building is sound. You inspect it yourself. So let's put on our hard hats and start tapping on these walls. I'm done with the victory lap. I want to know about the things that could bring this entire structure crumbling down.
All right, fair enough. A real analysis demands we look at both sides of the ledger, so let's do it. Let's dig into the balance sheet, look at the company's own warnings to investors, and see if there are any red flags hiding in the fine print.
Okay, first things first. Let's run a check on the quality of these amazing earnings. This is the Binish M-score. It's basically a mathematical model that uses a bunch of financial ratios to see if a company might be playing games with its numbers. Now, let me be crystal clear here. This is not an accusation. It's a statistical flag. A score greater than -1.78 suggests a higher probability that a company is managing its earnings. Smithfield's score? -1.72. It just barely trips the wire. It doesn't prove anything is wrong, but it tells a skeptic like me that we need to look at these incredible numbers with an extra dose of scrutiny. It's the first small crack we found. Let's keep looking. You know, earlier you showed this chart as a sign of strength, and you weren't wrong. Packaged meats is a beast. But when I look at this chart, I see something else. I see massive concentration risk. A full 71% of the company's entire operating profit is coming from just one segment. And here's the kicker that got buried under the celebration of the hog production turnaround. The profit from their main engine, the packaged meats segment, it actually declined by 6.4% year over year. You heard me right. Profit from their most important division fell by $74 million. The only reason the company's total profit went up was because of that huge one-time looking swing in the tiny hog production segment. That suggests to me the core engine might be sputtering, and that is a huge concern. And look, you don't have to take my word for it. Let's just read what the company itself tells investors in its own SEC filings. These are the official risk factors. Commodity prices are cyclical. The tailwind they have now could easily become a headwind tomorrow. They're dependent on third-party suppliers. They face geopolitical risks and tariffs. And look closely at that fourth point. They are a controlled company under the Hong Kong-based WH Group. That creates potential conflicts of interest when it comes to strategy and how they spend their money. The company is literally handing you a map of the minefield you have to walk through as an investor. All right, now let's talk about the thing that keeps every skeptic up at night, what you can't see. We're talking about off-balance sheet risk. These are the hidden icebergs. A company can look squeaky clean on its main financial statements with low debt, but these hidden guarantees and obligations can sink the ship if things go south. It's something you have to investigate for any company, especially one with a complex, global corporate parent. And after digging through their latest 10Q filing, we find a perfect example. Smithfield is on the hook, guaranteeing up to $61 million in debt for a joint venture they're in called Monarch. Now look, is $61 million going to bankrupt a company this big? No, of course not. But it's a real liability that doesn't show up on the main balance sheet. It's a guarantee. If Monarch defaults, Smithfield has to pay up. It just proves there are hidden complexities in their corporate structure. It's another stress point that has to be monitored. And it really makes you wonder what else is out there.
All right, you've definitely pointed out some potential stress points. I'll give you that. The concentration risk, that Benchmark score flag, the off-balance sheet items, these are all valid points any serious investor needs to weigh. But a company isn't static. It's not just about its past. It's about where it's headed. And Smithfield isn't just sitting back and counting its money. They are actively forging their future to try and strengthen their core business.
And here is their blueprint for growth. Look at this timeline. In January, they announced the acquisition of Nathan's Famous. That is a brilliant move to add a high-margin, iconic brand to that key packaged meats segment. In February, they announced a huge investment in a new, state-of-the-art facility in Sioux Falls. That is a direct attack on their cost structure to drive long-term efficiency. Then in March, they issue guidance for continued growth. These aren't the actions of a management team that's scared. These are bold, confident, forward-looking moves.
And I see a puzzle in that blueprint. A big one. Look at their own guidance. They're projecting operating profits somewhere between, let's call it 1.3 and 1.5 billion. Okay, but then you read the fine print, and it says this guidance excludes the impact of their two biggest growth drivers, Nathan's and the new Sioux Falls facility. Why would you do that? It just creates this fog of uncertainty. Then look at what Wall Street is expecting for earnings per share, $2.44. Based on the company's own profit forecast, that EPS number looks awfully optimistic. It feels like the analysts might be getting a little ahead of their skis here, which is a classic setup for future disappointment. Okay, we've laid it all out. We've heard the powerful bull case, which is built on a foundation of record profits, a brilliant operational turnaround, and direct cash returns to shareholders.
And we've heard the cautious bear case, which points to that heavy concentration risk, the statistical red flags, and the undeniable uncertainty in their own forward guidance. The evidence is on the table.
Now it's time to weigh it all and deliver the iron financial verdict. Is this thing an opportunity, or is it a trap?
Let's break it down point by point. On profitability, the bull case is simple. Record profits and that mind-boggling $320 million swing in hog production.
But the bear case fires back that they are dangerously over-reliant on packaged meats, where, let's not forget, profits actually fell last year.
Okay, the balance sheet. The bulls will point to an incredibly strong financial position with a net debt-to-EBITDA ratio of just 0.3 times. That is Fort Knox level solid.
But the bears will raise that Benish M score flag and point to the hidden risks lurking off the balance sheet, like that Monarch guarantee.
What about growth? The bull case is clear. The Nathan's acquisition and the new Sioux Falls facility are powerful engines for the future.
But the bear case correctly points out that both of those engines are excluded from this year's guidance, which creates a fog around what to expect.
And finally, for shareholders, you can't argue with that 25% dividend hike. It's a huge vote of confidence from the people in charge.
But the skeptics will remind you that this company has a 3-year revenue growth decline and the stock is highly volatile. This is not a ride for the faint of heart.
So, where do we land? What's the final verdict? Here it is. Smithfield has built a structurally sound fortress. The balance sheet is a thing of beauty, the cash flow is enormous, and that turnaround in hog production was a masterstroke of execution. You simply cannot ignore that level of financial strength. However, and this is a big however, it is a fortress that has clear stress points that must be monitored constantly. That over-reliance on the packaged meats segment is a major concentration risk, period, especially since that segment saw profits decline. And that Benish M score is a nagging flag that you can't just ignore. The company is solid, but it is not simple, and it requires constant vigilance. And that really brings us to the final crucial question that we're going to leave you with today. Management proved beyond a shadow of a doubt that they could fix their biggest, most painful problem area in hog production. That requires immense skill.
But the future success of this company and its stock now hinges on something else entirely. Can they restart the growth in their main profit engine, that packaged meat segment, which clearly stalled out this year?
That is the billion-dollar question. And the answer will determine whether this fortress continues to get stronger or if those stress points we found start to widen into serious cracks. As always, do your own homework.
This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.